Property investing has actually fundamentally changed. The government has started the war against investors. So we've got two wars happening at the moment. We've got the war in Iran and the war against property investors. There's going to be two types of people at the end of what's happened now. There's going to be one group of people that are going to lose big time because they're not going to understand the new rules of real estate. And then there's going to be people that understand the new rules of real estate and they're going to make really good money. And our clients over the last 20 years, we've had over 3,500 members and they've all made lots of money. Not one person has lost money in our program. Now, with the new government changes, things are going to be very different. Our program and what we're doing, because of the fundamentals, is actually going to be even more powerful. The difference between what we can do and what the average investor can do now with the wrong strategy is huge. Okay, hello, this is George Markoski coming to you live with the Positive Property Show, and welcome. The war on property investors has begun. Let's break this down and show you what's happening. But just to let you know, property investing has actually fundamentally changed. It's never going to be the same again. There's one of those key moments which is so important because there's going to be two types of people at the end of what's happened now, recently from the budget, the 12th of May. There's going to be one group of people that are going to lose big time because they're not going to understand the new rules of real estate and they're going to miss out. And then there's going to be people that understand the new rules of real estate and they're going to make really good money. And it's your choice what you're going to do. Are you going to get educated and become a successful investor, or are you going to miss out? Because the government has started the war against investors and they've really changed the landscape considerably. Let's go through this and show you what's happening. And also later on tonight, Adam's going to join me and we're going to be talking about property, building, and what's been happening. So what happens next? Jim Chalmers and Albo have started the war on, I was about to say war of terror, but it's actually the war on property investors. The state of the nation. This is what's happening at the moment. So Jim Chalmers, he's been accused of favouring foreign multinationals over mum and dad investors. So basically, foreign investors are going to get to keep their 50% tax break on certain investments, but Australians are not going to be able to do that. Isn't that lovely? So 47% of voters are dissatisfied with the federal budget. I'm curious, type in the chat, are you happy, put a thumbs up, or are you sad and put a thumbs down? I'm very curious. 18% satisfied, 45% say budget decreased their trust in government. And the trust in government has been going down quite a bit. 61% expect further tax changes before the election. Voters increasingly expect more tax changes before the election. 61% believe further policy changes are still coming. Investors fear the war on property owners is just beginning and it's going to escalate. So we've got two wars happening at the moment. We've got the war in Iran and the war against property investors. And the fact of it is, the government are too gutless to actually do a war on big business that takes billions of dollars profits out of Australia, tax-free or minimal tax. And instead, what they want to do is they want to punish the average Australian who's actually trying to get ahead. But not only that, the fact of it is, people in Australia that are working hard at investing, right? Instead of this tall poppy syndrome and attacking them and saying they're the problem, think about this, right? You work all your life, you pay taxes, and then you get the pension. And people that are investing, they're not going to get the pension. So they're less of a burden to society. We need more people like this because we're not going to be able to fund retirement for everyone, right? That's the fact of it. So what I suggest everyone does is get off their tall poppy syndrome seat and start supporting Australians that are trying to get ahead. We really got to get rid of this mentality and really do that. So the housing court is 97,400 homes behind in the last 18 months. Housing construction is already falling well behind target. So the target was 1.2 million and we're tracking for 97,000 homes behind schedule just after 18 months. Now, the CBA forecasts only 885,000 homes delivered by 28-29. That is 315,000 homes short of the government's own target. NOM. NOM means net overseas migration. So net overseas migration is upgraded by another 55,000 people. Thank you, Labor. Immigration continues exceeding government forecasts. Population keeps accelerating while housing supply falls behind. More people competing for fewer homes is worsening the rental crisis. So the Albanese government recently celebrated building 45 social homes. That's 45, not 4,500, not 450,000, 45 homes, right? Now, just to put this in perspective, they've actually fixed about 5 minutes of underlying national demand. Bravo, well done. So, Labor, you're doing a great job. So, what this means for investors, the rules have changed, and here's the new playbook. Right, the big tax change most investors haven't understood yet. You hold property for over 12 months, right, at the moment, and you pay tax on only 50% of the gain. Now, the new proposed system they're putting in is the 50% capital gains tax discount largely disappears. Instead, you get a cost-based indexed inflation and a possible 30% minimum tax on real gains. This is the highest capital gains tax in the first world. The government's effectively saying this. If you are going to speculate and make money, we want our cut, right? Meanwhile, inflation silently pushes property prices higher anyway. The taxman just wants a larger share at the dinner table. So this is the thing. There's a window now, a 12-month window for people, right? If you buy property before the 1st of July 2027, your gains are split into two tax eras. So growth before 1st of July, old 50% CGT discount applies. Growth after 1st July, new index tax regime. So if you buy a new property in 2026, 700,000, the value in January 2027, 780, and then the value in 2023, 1.1, the first 80,000 growth is the old discounted system. The remaining growth is the new system. The line in the sand is 1st July. People waiting on the sidelines may end up trapped entirely inside the new tax world. So here's the twist. New residential properties may still get access to the old 50% CGT discount or the new index system. Now, this is a superpower and this is amazing, right? The government desperately needs brand new housing supply. So what they want to do is reward construction and punish established property investors. The winners are new builds, house and land, townhouse developments, build to rent projects, investors acting before 2027. The losers are people using outdated systems and waiting too long. The major property tax changes. Before the budget, all properties. After budget, new builds only. Before the budget, 50% discount. After budget, completely abolished. Now, tax on gains, effective 23.5% before the budget, now minimum 30%. The new build CGT is 50% discount. We get to keep that. And pre-May 12, 2026, everything is grandfathered that you already have. So negative gearing is completely limited to new builds, and the 50% discount abolished and replaced the minimum of 30%. So what's happening is, what you got to do is just recalibrate what you do, and then you can take advantage of this tax. So 30% minimal capital gains tax. Now, this is just not on properties. This is also on shares, on Bitcoin, and on startups. And the big issue is startups, because startups are very risky, and we need more startups in Australia so we can be innovative and compete with the world. But what's happening now is we're actually punishing people that are risking everything, starting a business, and then we want to tax the shit out of them. And a lot of these people might just go overseas instead and then pay zero capital gains tax. And that's the issue, because we need to retain talent and innovation in Australia. And the government is literally pushing people out of Australia. Now, this is the deal. Banks are already moving against established property investors. So what's going to happen is there's going to be two lanes. People that are buying established property investors, their borrowing capacity is going to shrink quite considerably. Macquarie, they changed their policy on the 16th of May. Net gearing is excluded from serviceability calculations. So that means your borrowing capacity has gone down. Westpac are looking at reviewing it 18th of May, and other banks are likely to follow. So what's happening is people's borrowing capacity to establish property is going to be cut down. When borrowing capacity gets cut down, that affects the ability to buy things, and that could actually affect the market. So we're in a very interesting place here at the moment in Australia, where we've got a lack of supply, massive demand. The government has pushed these policies that have completely changed the investment landscape forever. And what's happening is there's going to be a lot of turmoil. And I'll give you my prediction at the end of this and tell you what I think is going to happen. So the investor exit opens first home buyer window. And basically, first home buyer loan demand has projected to rise. where investor loans are invested to and projected to go down. And as I said before, entrepreneurs face the same 30% capital gains tax rate. The rules have changed, the market will too. The next winners will be people that know the new rules. Okay, let's talk about a case study and a real results. Okay, so I've got Jeremy Bagdalian. Hope I got that right. And if he's in the audience here, let me know. I'd love to talk to him after this presentation. So this is Jeremy, and let me tell you Jeremy's story. He bought a property in Beaudesert, 2 bedrooms, 1 bathroom, 1 house, and $364,000 is what he paid. Right, lovely property. He bought the property in Beaudesert, 364, and 20% deposit. So he paid $72,000, settled in April 2025 for 364. Today, the market value is 565. The current profit is $201,000 and it's renting for $450 per week. Now, normally when you buy a property, if you get a property at 364,000, the rent's going to be 360. So he's getting, the rent's gone up, the property value's gone up. And basically, 201,000 in 1 year. Now, currently, the average Australian makes $105,000 in 1 year working 40 hours a week. And then they pay tax on that. And Jeremy has made double that just out of his investment. Okay, let's finish this slide. Now I want to talk to Jeremy. Jeremy, how are you?
I'm good, George. How are you?
Very good. Now, did I pronounce your name right?
Baghdadlian. Not too far off.
Baghdadlian. Baghdadlian. Hey, there you go. Easier to repeat after I hear it. Awesome.
Yeah.
Jeremy, I'd like to find out a little bit about your journey. How did you find us first?
I stumbled across your videos on socials through Facebook, and after doing a little bit of research and reading Rich Dad, Poor Dad, I thought, enough's enough. I did have one property in Victoria that was rented out, wasn't cash flowing. I ended up selling that before I joined the course. But in a sense, I'm glad that I did because I don't think it was the right setup, and it gave me the capital to start up with positive property. And now,
Excellent.
yeah, already got one property with some decent capital there.
Look, so basically you saw me on one of these events that you're on at the moment on
Yeah,
Facebook,
correct.
right? Love that. That's great. So I love the way the circle turns. And in 12 months, you've made over $200,000. How does that feel making 200 grand in 12 months?
It's great considering I didn't have to work for it.
Exactly, exactly. And look, the fact of it is, this is what I say to people. Your number one goal should be to replace your income through property. Because once you do that, your world changes, right? And you've made 200 grand in 1 year, which is probably more than what you earn. I'm guessing,
Yep.
maybe. What were the hurdles? How hard was it? Because we hear all these great stories. You made 200 grand, but surely it wasn't that easy.
Well, having the initial deposit sitting there did make things a lot easier. Obviously, you stumble along delays throughout the build. The first house is pretty smooth, I guess, but I know going forward for the next one, I'll hit some hurdles with borrowing capacity and stuff like that. So, but just keep pushing on.
Yep. And what are your goals?
Ah, get enough properties under my belt that I can leave work and not have to work full time.
Fantastic. That's beautiful. That's beautiful. What would you say to people that are watching this live now, like you saw something on Facebook 12 months ago, looking into this? What would you say to them?
Don't wait. It's only
Exactly.
it's only going to get harder.
Yep. I think that's very good advice. I appreciate that. Thank you, Jeremy.
No problems.
Cheers. Okay, Adam, we're bringing in the big
Yeah.
guns tonight. Okay, we've got Adam here. Adam, hi.
Hello, team. How are we all tonight? How are we going?
Look, going really well. We've got a big crowd for you tonight. And the fact of it is, the government has started the war on investors. And the thing is, they may have started the war on investors, but we got a lot of tricks up our sleeve and we're going to fight back, right? And the fact of it is, whenever there's crisis, there's opportunity. And I want to talk about a little bit about what's happening at the moment with new houses and old houses and what's happening. The market, at the moment, we've got a two-speed property market where Adelaide, Brisbane, and Perth are growing really fast, and Melbourne and Sydney have stalled. And basically, what that means is Adelaide, Perth, and Brisbane are in the 7, 8 o'clock market, 9 o'clock. Where Brisbane, where Melbourne and Sydney, they're more than 1, 2, 3 o'clock in the morning, right?
Yes.
But there are some suburbs that are right down to 6 or 7 in those cities as well, which are really good. But I think there's going to be another bifurcation of the property market coming in very soon. And the bifurcation is where they split. And new properties and used properties are going to actually part ways. And they have since the 12th of May. Now, as we know, here as a group, we prefer new properties because we get the maximum tax deductions. And by investing in new properties, we get an advantage. We get an advantage with negative gearing.
Appreciation.
Yeah, exactly. Appreciation without having to work to fix things. There's no maintenance. There's a lot of
Repair.
there's the value stacks up. And it's been working very well. And our clients over the last 20 years, we've had over 3,500 members. And they've all made lots of money. Not one person has lost money in our program. Now, with the new government changes, things are going to be very different. And our program and what we're doing, because of the fundamentals, is actually going to be even more powerful. The difference between what we can do and what the average investor can do now with the wrong strategy is huge. Because not only do now our program, we've only got the properties that got the 100% negative gearing. We also got the capital gains tax savings. That's a big game changer, because I was doing the numbers before, and on $800,000 property, right? If you've got a property that's been owned for one day, 800,000, and then one that's brand new through us, over a 5-year period, there's a $300,000 difference in what you'll have in your pocket out of those two properties if they grew the same. 300 grand. I don't know for you, but for me, it's a lot of money.
A lot of money. But I
Right?
think we're also going to get a lot of investors playing in our pool now. So I've got a few mates of mine who liked the old second-hand property market, but
Yep,
I've
yep.
never agreed with them. But now they're all coming over to our side.
Yes, yes, yes.
So it's going to
And
hurt the supply now, because you've got all these investors who only invest in second-hand properties and now seeing the advantages of coming over to
yep,
brand new properties.
yep.
Yeah, so anyway, so like what I was saying, I think a lot more people are going to start playing in the new field of new properties, which is going to do two things: supply and demand, and push prices up again.
Yes, yes. And look, this is the issue. We got one, inflation, right? We've got massive inflation. It's already put property prices up. Two, now we've got more competition for people wanting brand new properties. So look, the one thing I've got to talk about is the fundamentals have not changed, right? What happens is you got policies that come in and out over the years. And this is nothing new to me. I've been through this many times with so many policies. The fact of it is, governments change policies. They changed, a while ago, they stopped getting, it was really good at one stage. You could buy properties in every state and get a tax deduction just for flying to that city, remember?
That's right. Yeah.
Oh, that was good.
You just go to Queensland on holidays, and
Yeah,
I'm looking at my holiday house. I mean, my
I had a
investment house.
property in every state, and I actually got a tax deduction for going to every place I went to. It was great,
Yeah.
which was amazing. Then they cut that out. Then what they did, they reduced tax deductions on old second-hand properties, and now you got no tax deduction on used properties at all. It's finished. So literally, what this means and what people have to understand is our strategy is so much more powerful, because I get a lot of people ask me about NDIS and
Mm.
multiple homes and what do you call it? What do you call those?
Multiple
Dual,
living,
yeah, dual. What are they called? The dual things?
dual key or dual lock.
Yeah,
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 dual
dual lock.
key.
And what I say to people is this, right? The
Rooming
problem with
houses.
these
Yeah.
is the only people that want to buy these are investors, right? Because you're not going to buy one to live in, are you? A
No.
rooming house or a dual key
A
or
four bedroom
NDIS
with
or
four en
NDIS.
suites.
Yeah, yeah. No, you're not going to do that. And now the fact of it is, the key to investing is capital growth. That's how you make your money. If you buy a dual key, NDIS or rooming house, how much do you think it's going to go up with these new
Well,
tax changes?
how much extra you're paying for it to get those three extra bathrooms and
It,
everything
it's
else.
just it doesn't, the numbers don't work at all. Those strategies are dead, and I'm warning people, do not buy these. I've warned everyone for 20 years straight now already not to bother. But now it's become dire, and literally you buy one of those, you're catching a falling knife, because the value of that property disappears as soon as you buy it, because suddenly there's no tax deductions after you finish. Very powerful.
Yeah.
Now, what we buy well-priced properties in the lower end of the market, and that's where all the demand is. And that demand ain't going to stop. It's never going to stop. That demand is very powerful. A lot of people are scared about the property market dropping. Do you hear people talking about 5 or 9%? Right? But there's a lot of
5% is
experts
not a
saying
lot.
a lot of experts saying that it might drop 5 or 9%. And this is what I'm saying. It may, but the properties that are going to drop are not going to be the properties that we're getting because these properties are too good value. There's no way. The properties are going to drop are the properties that are bad value, that aren't valuable anyway.
Well, I call it the pyramid. The ones at the top, the exclusive, 1 million to $10 million houses at the top of the pyramid, they're the ones that are going to drop. The ones at the bottom, everyone can afford them. It's the affordable
Yeah,
housing.
exactly. No, those affordable
You're always going
properties
to
that we
find a
get.
buyer,
No, you always find a buyer. There's going to be first home buyers always ready to buy
always.
because you, as an investor, you're not going to sell your property to an investor. Never going to happen. Therefore, you need to buy a property that someone wants to buy down the track. And that's exactly what we're doing, which is brilliant. So I think what we should do is open up the Q&A. Okay, guys, let's ask the questions. Don't care. Both sides of politics are a joke. Yep, true.
Agree with that one.
A
Is
dual
that
key
in
the same as
Facebook meme here?
duplexes. A dual key and duplexes are different. A dual key you can't split. A duplex you can split.
Yeah, split into two titles.
Yeah. And the fact of it is, if you can split it into two titles, it's much better. Miles ahead. Because if you can't split it into two titles, it's really bad. Easy fix. We get taxed to the hilt, raised your rent. George, did you make the rent vesting word? I remember some older videos from 10 years ago that mentioned it. I don't
Yeah.
know if I made the word up. I
But
probably
you were talking about it 10, 15 years
I,
ago.
I was talking about because I was doing it.
Yeah.
Right? That's why.
Renting
Remember,
where you
Adam,
want to
I
live.
was living on the beach, and at the time, interest rates were very big, and the person that owned it was subsidizing my rent. I lived on this beautiful house right on the beachfront. You stayed there, Adam,
Yeah.
with me, and that was about 15 years ago. And I was paying like $1,000 a week, and the owner of the property was paying 200,000 a year just to pay for everything for me. It was great, and that's because blue chip's not good return. The guy was losing, but now what's going to happen? Okay, so that guy was losing 150,000 a year, but he was getting a tax deduction, and they're theologist, so he was making probably $1 million a year. So therefore, that 150,000 he was losing, he was getting a massive tax deduction. It didn't bother him one little bit. Great. What happens now though with that property? You can't afford to lose 150 and get no tax deduction.
Get nothing.
You get nothing. That's a big change, a massive change.
And that's
So
why all those investors are going to come, all the people who are looking at buying secondhand are now going to come over and buy new.
yeah, the property market has changed fundamentally. It's going to be huge.
Mm.
This is a massive, massive change. And I don't think any government's going to have the incentive to do this because every government likes getting tax dollars, right? So let's say Liberals get in, they're not going to change this. You know why they're not going to change it? They're getting free money that the Labor get a bad view from because both parties want money out of us. They're just too scared to get it. So it's not going to change. That's the fact of it. Wouldn't that beachfront property be grandfathered?
Yes, it would be
Yes,
now.
yes, it would be, of
If you
course.
bought it, if you
No,
bought it now.
no one's going to sell, right? The fact of it is, if you've got a property, it's grandfathered, the longer you hold it for, the more tax you're going to save. And I'm going to talk about property updates once we go in our private group. So I'm going to answer any other questions, then we're going to go to a private group, then we'll talk about property updates. The fact of it is, it's costing more to build now. And there's going to be even more pressure for properties because there's going to be more demand. So the fact that it's getting properties is actually getting harder, not easier. Isn't that crazy?
Well, especially, new properties is harder. It's going to be a lot more secondhand, which is what the government wants.
Yeah,
First home buyers to be able to buy.
that's right. Someone said if capital gains tax only applies when you sell, why is it such an issue when best practice is not sell? Yes, best practice is not sell. I agree.
Spot on.
And true. The fact that it is, I don't like selling, but sometimes you do need to sell. And the thing is, the people that need to sell usually is the young investors that are starting out because you sell one to try to get into a bigger one and things like that. And what the government's saying is they're helping the young investors, they're doing the opposite. And that's the thing, right? The fact of it is, the people that have got lots of properties, they're fine. And our system, we're not selling anyway. We're accumulating property and it keeps going up and it keeps going up. We don't want to sell it because why would you sell an asset if it's going up in value?
And just use the equity to buy something else.
Yeah. Okay, we're looking at selling our PPR to buy two investments. Our concern is the time frame on getting back into the property market down track for a PPR. Look, if your principal place of residence is going to be a second-hand property, you don't have to worry about that as much. What are the general rules? Because Craig and Tanya were saying about their PPR. I would say that properties that are secondhand are going to be actually cheaper to buy because there's less competition for them. What are your thoughts?
Yeah, I agree with you.
Right? That's
Because
the
there'll
fact.
be less people, supply and demand, less people
Yep.
wanting it. It's taken all the investors out of the market for secondhand
Yep.
property.
So if you look at that graph that I had before, loans for first home buyers and loans for investors, there's more loans for investors than first home buyers, right? Investors are the biggest people getting loans. That's going to change now. But all the CG will also apply when you pass your portfolio to your kids after they're gone. The capital gains tax, that's interesting. Good question. What do you think?
Yeah, I don't know that one.
The
I
fact
know
that
that they were trying to sneak in like a sneaky death tax there somewhere, but I don't know about
they're
this.
trying to
There
do that.
was
Yes, they're
something about
trying
if
to.
you owned a property prior to 1985 or 1983, there was no capital gains, but then it was, yeah, it's black. It's I don't know if that one's black and white yet.
Accounts are going to make a pack explaining and implementing these changes. Absolutely. The fact of it
Yeah.
is, it's pretty simple, but accountants are going to make a fortune because a lot of people don't understand it.
And people, valuers, people having to value their property by July 1 next year, because everyone has
And
to have
look,
a
and the
valuation
thing is,
done.
the changes haven't really been put in place yet anyway. That's the fact of it. So we've still got time to see what happens. But we've got this 12-month window till the 1st of July 2027 that people need to buy. Yeah. So it's going to be interesting. You have 2 years to sell it and you don't get tax. There's no tax inheritance yet. Good.
Yeah. Okay.
Yet. The government's going to keep going after our money, right? And that's why we have to get smarter. And this is the deal. What's going to happen in the end, and this is what all the super rich do. The super rich don't sell. Leah said, I missed that. Do we have to do valuations? No, we don't have to do valuations. We're not going to do that. The reason being is what we're going to do is we're really going to stick to the formula that the super rich use, where what you do is get your equity and get loans against your equity and take your equity like that instead of selling. Because selling is just bad news and costs money. And you want to try to avoid it if you can. You'll own nothing and be happy. Yep, that's what they say. But, part of our group, you know what we say? We're going to own a lot and then be happy.
Yeah.
That's the fact of it. So basically, property prices on new properties have to go up because they cost more to build because of the big war in Iran at the moment and inflation. And inflation is going to push everything up. What happens if you buy now doesn't settle? It doesn't matter because the government always looks at the contract date. That's part of the rules. So the rules are they don't look at settlement, they look at contract date.
And you're fine up until July 1, 27.
That's right. I've never met a Labor voter.
You probably don't want to.
Oh, look, the Labor voters, who are the Labor voters anyway? I don't know.
Government workers, aren't they? I don't know.
Immigrants
Yeah.
hiding. Yeah,
Yeah.
I don't know.
All right.
And
Should
I'm
we go to
not,
the next
yeah,
group
okay.
before we get into trouble?
Let's go to our private group. What I want to say to everyone is this. Before we go into our private group, I want to say this to the public group. If you're listening to this, basically the rules of property have changed. And the people that learn the new rules are going to make money. And if you don't learn the new rules, you're going to miss out. That's why I'm actually holding a webinar next week called The New Rules of Real Estate to show you exactly how to do it. So if you're watching this on the socials, type in new rules and my team will reach out to you and come along to my webinar. It's a free webinar. It's 90 minutes. I'm going to break down what the changes are, how they affect you, and how you can actually make a lot of money out of this. Because that's the important thing. Because there's going to be two types of people. There's going to be the people that don't learn the new rules, and they're going to be the losers. Once again, they're going to miss the next boom. There's going to be the people that listen to my webinar and watch it, and they're going to actually make money. Thank you.